This podcast is brought to you through our charitable partnership with Children's Home Society of North Carolina. Right now, there are more than 12,000 children living in the foster care system and not nearly enough safe, loving homes for them. Find out how you can make a difference today at chsnc.org.
Welcome to the Semmax Way, the definitive podcast for mastering finance, investment, and retirement planning. Prepare to unlock the secrets to financial success as we delve into lucrative investment strategies and provide expert guidance towards a secure retirement. With over 20 years of experience, Semmax Financial Group has been dedicated to serving investors, and through this podcast, we aim to empower you with the knowledge to maximize your savings and achieve lasting financial freedom the Semmax Way. Whether you're a professional finance enthusiast, a high net worth individual, or part of a sophisticated investment group, this podcast is tailor-made for you. And now, here is your host, Matt Landon, financial advisor for Semmax Financial Group and licensed CFP.
Hello and welcome, everybody. I'm Matt Landon. I'm a licensed CFP and I'm a financial advisor with Semmax Financial Group. And I am so thrilled to be taking this journey with you today. Now, what we're trying to accomplish here is to achieve financial prosperity and help you unlock the secrets to a secure financial future. Whether you are a seasoned investor or just beginning your financial quest, this podcast should be your gateway to some expert advice, some insightful strategies, and some good wisdom that you can grow and learn with. Now, what I want to talk about today is target date funds and how to approach it the Semmax way. When we speak about the Semmax way, what we're really talking about is a philosophy towards investing, an approach that is holistic in nature. We want to be thinking about things from a risk standpoint, but we also want to be looking at the tax implications. What is the rate of return? What is the income producing opportunities out of this? What are the investment strategies we can employ? What is the charitable giving and the charitable opportunities we have here? I think it's important not to miss the forest for the trees. And so when we're talking about any one specific investment strategy or thing, we want to be looking at it through those multiple lenses and looking at how does this part impact the whole. Now, when we talk about target date funds, is what they are and then also what they're not. Now, here's the beautiful thing about target date funds. For those of you that don't know, a target date fund is simply a fund that you can allocate your 401k or your 403b or a different investment account from an employer into, and it just says, hey, I'm planning on retiring 20 years from now. So I'm going to pick a fund that has a date 20 years from now. And what that means is because I have that longer horizon, it's going to be more aggressive. Now, as you get closer to that date, you're going to consistently get more conservative. So if you have someone who's 25 years old and is looking at things and saying, I'm planning to retire at 65, I have 40 years to invest, but I don't really know much about investing. What do I do? Well, you can throw it in that target date fund and know it's going to be aggressive. It's saying you have 40 years of investing future ahead of you. There's a couple things that come into play with this. The idea here is, one, they do it in increments of every 5 years. So you might go, well, I've got 23 years. Well, we can pick one that's 20 years out. We can pick one that's 25 years out, right? You know, there's a little bit of nuance there. But the other thing to keep in mind is just because you have a target date fund that says you're retiring at this date, you should be here, that's not necessarily accurate. One, retirement is not the ultimate finish line. It's a finish line, but it doesn't mean we're done investing. And one of the things with target date funds is they get consistently more and more conservative as you approach retirement. Now, that may be appropriate with a piece of your funds, but you might want to be a little bit more aggressive with others. The other issue with target date funds is you don't necessarily know what's inside of them. You don't have as much control. Now, I'll give you an example here, and I don't want to make it seem like I'm waving a giant American flag screaming USA #1. You shouldn't have your funds in anything else. You've got to be US based. But when you look at the international market, you may be looking around right now and going, I think I'd much rather be invested in the US. I don't really want to have a whole lot of international exposure. The issue with a target date fund is it just looks at at the timeline and says, well, if we are 27 years away, then you need to be this percentage in international funds. It doesn't really take into account the fact that the international market may be performing excellent or poorly. It just says you need to be allocated this much here. It's the same thing when we're talking about bonds. Take last year, for example. Interest rates are climbing. The Fed come out and they say, we're going to raise rates and we're going to do it repeatedly until we get this inflation thing under control. What that means is the bond market is going to take a hit. You don't have to be a bond market expert to understand when interest rates go up, bond values go down. But the thing is, if you're in a target date fund that says you're retiring now, or you may have retired 4 years ago or 5 years ago, then it's going to be heavily tilted towards that fixed income. The issue you run into then is the Fed just came out and said, hey, we're raising interest rates. And what that means is your bond values are going to drop. Now, this is a pretty easy principle to understand. Think about it this way. If you have a bond and it's paying you 4% interest, you have a $1,000 bond, it's paying you 4% interest, and someone comes along and says, hey, I'm going to buy your bond. I'd like to buy your bond. And what's it making me? You go, well, wait a minute. It's making you $40 every year. You're getting 4% interest. And it's going to do this for the next 10 years. And you go, that's pretty good. But the Feds come out and say, we're raising interest rates. And you say, I want to sell that 4% bond. Someone's going to look at you and go, wait a minute. Your bond is only going to give me $40. I can go out and buy another bond from the same company or from a different treasury, same duration, and it's going to give me 6%. I'm going to make $60. Why would I spend $1,000 to buy your 4% bond when I can spend $1,000 and get a 6% bond? So then you're left going, you know what? I don't want to do it, but I'll take less than $1,000. I'll take less money for it, right? So what happens is when interest rates are climbing, bond values are dropping. The inverse relationship is true as well. If you've got a 4% bond, interest rates are only offering 2%, someone's going to look at you and they're going to pay you a premium for that bond. Now, tie that in with what's happening in 2022. We're in a market, we're in a rate where inflation has been running rampant, and you've got the Fed coming out saying, we're going to raise rates because we got to get this thing under control. Well, the moment that happened, it means your bond portfolio is going to take a hit. Now, an actively managed portfolio is going to look at that and say, you know what? We probably need to reduce your bond exposure. We need to take down the duration. We need to make some adjustments to your portfolio and your strategy. The issue with a target date fund is your fund manager inside of that target date fund is very aware of that issue. He's aware of how interest rates affect bond values, but they're handcuffed to the strategy. The target date fund says, wait a minute, you're 5 years away from retirement. You need to be allocated this percentage to fixed income, whether you like it or not. It also says if you're 20 years from retirement, you need to be allocated this much in international, whether you feel like international is a place you particularly want to be or not, right? It's the same thing with large cap growth, with technology stocks, with small cap, mid cap, etc. I'd like to pause a minute and just express our gratitude to our podcast sponsors, Noble's Food and Pursuits. This renowned restaurant group has been serving the community for an impressive 40 years, starting with Jim Noble's original restaurant, J. Basil Noble in High Point. Over the years, their passion for hospitality has flourished, leading them to expand into a diverse collection of 9 restaurants, a retail bakery, and a catering company. Today, we want to shine a spotlight on one of their beloved establishments, Rooster's A Noble Grill, which has been proudly open for 31 years right here in Winston-Salem. Now, Rooster's is known for its commitment to offering a seasonally inspired, regionally cultivated menu featuring mouth-watering wood-fired meats, poultry, and vegetables. If you're looking for a delightful dining experience, they also host monthly wine dinners and provide live music on their inviting patio every Tuesday night. Now make sure to pay them a visit at 380 Knollwood Street, and to secure your spot, head over to theroosterskitchen.com and make a reservation. Again, that's roosterskitchen.com. Trust us, you won't want to miss the delectable dishes and warm ambiance that Roosters has to offer. Now, let's continue exploring the world of finance and uncovering some strategies to help you achieve your financial goals. I don't want it to seem like I'm sitting here saying that you shouldn't be in international stocks ever, right? I don't want it to seem like I'm sitting here saying you should never be in a target date fund. I think a target date fund does have its place. And the place is when you first start investing. If you don't know anything about investing and you come in, I think using a target date fund and getting started in your 401k plan, getting into the market, being invested is a great thing to do. So I don't want you to throw the baby out with the bathwater here. I don't think target date funds are the worst thing you can be investing in. The worst thing you can be investing in is nothing, because that's guaranteed to make you nothing. However, I think that an active managed portfolio is going to do a little bit more of a comprehensive, detailed approach unique to you. And in my opinion, I think having more control is always better than less. But I don't want you to think I should never have target date funds at all. So I would just say this. If you've got someone who says, well, I'm just stepping into working, I just got my first full-time job, what do I do? I say, if you don't know any better, start with a target date fund. Go ahead, put it in there. Make sure it's a more aggressive one. You got a long ways ahead of you, kid. Go ahead and get started. But I don't want you to sit here and say, we'll just do that forever. Because especially as we're approaching retirement, there's more of a shifting that needs to come into play. You may look at this account and say, well, I've amassed a large 401k balance. Perhaps some of it needs to be conservative to produce that income I'm looking for in retirement. But some of it needs to be more aggressive to combat inflation, to be there for further on down the road. You may be in a situation where you're saying some of this 401k, I may not be utilizing at all. These are funds that ultimately I'm planning on leaving to my kids or my grandkids. And so that's a position where you might have a little bit more leeway to be more aggressive. So I think a target date fund is fantastic for those first starting out, but I wouldn't be in it forever. Now, the more you learn, the better you can do. I don't want anyone to be scared away from using target date funds to start, but I'm a big advocate for learning from them. Now, I hope this has been beneficial and you've been able to understand how these work a little bit better. If you have questions around it, please don't hesitate to reach out to us. I love talking to folks. I love answering questions. You can send us an email. You can call the office. You might be in a position where you say, I want to sit down and talk through some details and see what some other ways we can do it. Let's do it. I hope you enjoyed it. I know I have. This is just one small slice and a really big pie. I look forward to diving back into it with you again. Just keep this in mind. We're going to be looking at a lot of different parts and pieces, and we're going to do it all the Semmax way.
Thanks for joining us for another episode of the Semmax Way. If you're not completely satisfied with your current financial advisor, give us a call for a second opinion. Please note that this podcast is intended for informational and entertainment purposes only. The content shared on the Semmax Way should not be considered as investment advice. It is always recommended consult your licensed investment representative and a competent tax advisor, respectively, for your fiduciary needs and plans. No statement contained in the Semmax Way podcast or made by its producers, sponsors, host Matt Landon, or Semmax Financial Group is a recommendation. Semmax Financial Group and Matt Landon are not responsible or liable for investment value loss of any kind from any action taken based on information discussed in the Semmax Way podcast. Any opinions or viewpoints in this podcast are shared for information and entertainment purposes only and are not financial advice. We do encourage you to conduct further research and seek personalized advice for your specific financial circumstances. Full disclosure available at semmax.com/podcast. Thank you for joining us, and we look forward to having you tune in for future episodes of the Semmax Way.